Chakri Lokapriya as well, who joins in on the show, and have him share his outlook on the markets. Chakri, we were actually looking at the streak of order wins from a company like BHEL, and that has been pretty phenomenal since the start of the year. Just recently as well, a fairly sizable order is what they've bagged in their kitty. What would be your outlook, given that this for the longest period of time was one of the slowest moving stocks? Now, what's your sense of BHEL?
BHEL has got a new leash of life with a renewed interest in power. And power, always India has been a power deficient country, but now it's a combination of both thermal and green energy. Now, after these order wins for BHEL, I think their earnings is going to go up significantly, i.e. is going to go up for like 5 or 6 times. And so this kind of an earnings revival, and that, these are, large projects, the EPC projects that BHEL needs to execute over several years. So what that does is, provides order book visibility, earnings visibility. The company's multiples are not expensive at current times. And therefore, I think, even if you assign a far lower multiple than it traded in the past, BHEL can trade much higher.
Okay, fair enough. What about your sense as to, since you touched upon the power sector as a whole, even the likes of PFC, REC, a lot of names within this space have been showing increased resilience. Do you believe that this very ignored sector for a long time now merits a mention or a relook for the long term?
Indeed, absolutely. And, just like BHEL is going through a new leash of life, so is PFC, Power Finance, and REC. I remember very well participating as an anchor investor in IPOs of these companies, and they were priced at 1.5 times book then. Today, they trade at less than 0.7 times book, half the valuation. Now, with the growth rates going to far exceed what it did in the past, I think it's just a matter of time. The stock even trades closer to its book value and higher, so which means there's still a lot more upside from current levels, and also the dividend yield on these stocks, even at current prices, is close to 6-7%, which means it's better than putting in a bank FD.
Let's get right back to it. And what's your understanding of how trends have shaped up within the entire auto space? Do you think that with Maruti as well coming out with their new launches and focus on EVs, that it is likely to emerge as one of the frontliners within the auto space? What are your top picks?
Maruti is one of the clear market leader. It has more than 50% market share in the passenger vehicle segment. And so, and now it's introducing, I think, 6 or 7 new EVs by 2030. So, which means that in the mass mid-market, the company will continue to maintain its leadership with the launch of these 6 or 7 new EV products. This was the big fear about Maruti, that they did not have an EV lineup. And that fear is now kind of abated. And therefore, I think its multiples will re-rate and its earnings will be revised upwards. So I think Maruti looks good here. And Hero Motors, the similar issue with the launch of their new product. Again, now there is competition, a good product compared to Bajaj and its competitors. And therefore, I think Hero Motors also is likely to see earnings upgrades as well as a multiple re-rate.
Chakri, as a sector, what's leading to underperformance from the private banking majors? I mean, everything from an HDFC Bank to a Kotak to an ICICI Bank.
I think in the case of HDFC Bank, I think it's more company specific after the merger. I think they'll have some cost of funds issues until that settles down in a couple of quarters. I think it's in a wait and watch mode. And Kotak, on the other hand, is still a very expensive bank, valuation wise. Excellent bank, but expensive bank. In the case of ICICI and Axis, I think the big run-up has happened. They're trading at their historical price-to-book multiples. So if it continues to do that, so you'll make that 20-25% return over the next 1 year or so in each of ICICI and Axis Bank. But I think, there's so much of if you look at the mid-cap banks, if you look at the NBFCs, they all have derated in the past. And now with the valuations catching up, I think that's where the interest is more right now.
Right. Okay, that's the take coming in on which way banks are headed. Kunal, what's your sense individually on the Nifty Bank and what's looking like the weakest link amongst that?
Well, apparently the weakest link from the banking indices are actually the private sector banking stocks, and I would not say the weaker end in the sense that these stocks are correcting very sharply. Most of the stocks in the large cap private sector banks are just lying low into their lower end of the trading range. There is not too much of an uptick into these stocks, neither a major correction which is seeped into this name into these kind of stocks, except for yesterday's price action throughout the day right from the start, where many of the private sector banks they sold off from their day's highs. There is not too much of a trend emerging into this space, and that's where I would believe that there is some sort of underperformance which is actually coming in.
Okay, let's move right on then. And today, what's the stock on the editor's radar? It's Max Financial Services. Let's discuss this. Lots of triggers. Axis infusing about 1,600 crores and valuations as well as at a steep discount compared to peers.
Okay, there's one more trigger, which is that the erstwhile promoter and the pledge holding. So, while fundamentally, if one looks at Max and compares the franchise value, it is trading at a discount. But the reason why it's trading at a discount is because the other franchises which are there in the insurance space, they have a bigger commanding premium and the return ratios are better. So the prompt for our viewers here is that Max Financials, yes, it is trading at a discount, but that can be justified. But the trigger and why we have this stock on our radar, because it's a report from Investec, is because of the overhang of the promoter selling. And the promoter pledge is something which in a sense has been this eyesore for the stock, because markets knew that sooner than later the promoters would be selling. Last couple of days I think they've sold about 3.5% stake, and that is an indication that the promoter deleveraging is moving in the right direction. That's part one of the story. Part two of the story, I genuinely feel that insurance should come back. I think insurance is one space where the trends have stabilized. The margins have stabilized. That COVID up and down which happened, that seems to be stable. The budget derating which happened, that seems to be stable. So I will not be surprised in the second half of this year, at a time when banks are underperforming, money actually will start migrating back to, let's say, AMCs and insurance. And within insurance, Max is cheap. There is a trigger in the near term, and given that Axis can give it scale in coming years after the capital infusion, the historical growth rate versus future growth rate, the future growth rate could be better.
All right, future growth rate could be better. And with that, Aisha, I'll hand it right back to you.
Okay, that's the stock, Max Financial Services, that we're talking about right now. But Chakri, what is it that you're making of the larger insurance gamut?
Max Financial Services is actually kind of better placed because of all these triggers. And, with Axis Bank as a distribution partner, a long-standing one, and that's set to expand its, commitment to Max. I think that bodes well, given the valuations are cheap. But insurance as a sector is going through all these pricing issues. They have the volume growth in place. That's not a problem, but the pricing. And therefore, it will be one of a gradual re-rating over time, rather than an immediate boost to earnings in the near term.
Naresh, everything can go up, but can I say that that not hold true for LIC?
Not necessarily. We just need to make a few memes and it would turn around. So the fact is, it has gone through a lot of, say, a period of where it has gone sideways. But if you look at it purely on a technical basis, it has started making that reversal. So the stock topped out at 770 last year, went down to 540. And since then, it has slowly moved up to 650 levels. The last big gap down where we saw tick for the stock was around that 670 mark. So once it sustains 670, 680, it would actually be a short-term breakout. So the stock is actually on the radar for a breakout. It's got tighter and tighter in the range. And now it trades in a 10-pointer range for the last almost 1 month. So could be interesting watching it if it can sustain 670 odd levels. We could go back to 770 and higher.
Fair point. What is your view on LIC specifically, Chakri?
LIC, I think it's one of those valuation-wise clearly very cheap. It's a company which is stuck with, it's the discount assigned to a government company having such a large government stake, and the issues associated with that. In terms of LIC is a very uniquely positioned versus other PSU companies. So I think that one, it is still impacted by the larger insurance issues of lack of pricing power. It has a market share, valuations are on its side, but there is no immediate business trigger which will give a kind of an upgrade to its earnings. That is what is holding back LIC.
Okay, Chakri, stay on with us. We've got some more stock ideas coming in. Let's hear out Sanjeev Haseen and what's the stock that he's betting on?
The best play, which is going to be star as far as the AI circle goes, and which is seeing huge amount of order inflows and high margins. Their attrition has been the lowest, and I think LTIM is one large cap which I can now bet on because it's on the index. So like I said, I'm focusing on large caps in the index. LTIM, Reliance, ICICI Bank, Axis, and if we are going to see Bank Nifty expire above 45,000, then both these large caps have to join. But LTIM is my stock for this from here till Diwali. 6,000 plus is coming on LTIM by this Diwali.
Okay. The markets are, or the GIFT Nifty is indicating that things are just not going anywhere. Naresh, we spent a lot of time yesterday discussing Tata Chemicals, and we discussed Tata Chemicals the day before also. But yesterday, if one looks at the intraday graph, what looked like a promising breakout turned out to be a disappointing day or disappointing, trend.
So Tata Chemicals has been a stock which has made too many false moves over the last 2 months. So the problem is every time it has crossed 1,000, 1,050, it has again pulled back below 1,000 levels. Now the case point is even if we go further back in 2022, 1,000 to 1,050 was a resistance. We crossed about this only temporarily on some news back in August, September of last year, where it went to 1,200. So it has multiple resistances around this part. 1,050 to 1,080 now has become the new resistance. So technically, yes, the stock is trying to make a breakout move. Out here, I would keep a stop loss at 1,020 and see if it can break out going further. But after a couple of stop losses, even I have been not looking at it as closely. Got stopped out a couple of times. Every time it has flopped. So would wait it out, but technically the structure still looks positive.
Shifting gears, Zomato. Who's going to talk about Zomato? Chakri? Naresh?
Yeah.
Kunal is not there. He would have also spoken about Zomato. He's ordered something, I know it. He's gone to deliver the food which is coming from Zomato.
Zomato as a stock has done exceedingly well. This is one thing which is kind of made a small, tiny profit, but so it showed that it can make a profit, I guess. And now some of its subsidiaries have done a funding raise, and that was at okay valuation. So that kind of provides a bit of flow on its hyperlocal delivery business, which there was a lot of skepticism about. So a combination of its regular business plus that the hyperlocal business, I think is kind of helped the stock, but it's done its bit. Now I'm not too sure how much of immediate upside is left in the stock.
Another stick pace, since we're talking about Zomato, has been the entire hotel stocks. In fact, there are a couple of brokerages as well who are talking about how they're bullish on the entire hotel pack. Well, their top pick may be Chalet, but just look at the moves on some of these hotel names yesterday. I mean, starting off with the big boy Indian Hotels, which held out almost about 6% in trade yesterday. Chalet was up 3%, and then that can be said about the entire pack as well. Let's bring on board Lemon Tree as well as IHH2. All of these stocks were holding out very, very smartly. Naresh, what is it that you're making of this big spurt across the sector that we saw within hotels yesterday?
So technically, the sector has gone through this phase of consolidation for the last few months. The trend continues to remain positive across the board. So starting off with, say, Indian hotels, if you look at what happened for the stock, it went into a up move. And for the last almost 3 months, it was in a tight range of 380 to 405. So that is where it gave a breakout yesterday. Very strong volumes, the highest volume in the last 3 months. So same as the structure, if you go to Lemon Tree Hotels, you'll see for the last almost 3 months, it was in the range of 90 to 100, broke out above 100. Made a move to 110, took a little dip, and now again trying to make a move above 110 levels. So the case in point is the sector went through the first cycle wherein it made a huge move in 2022-23, then consolidated, and now we are getting into the next part of the cycle. The belief has been low on the sector because of the cyclical nature, and previously from 2007 to 2021, The whole sector did terrible. The returns were zero for Indian hotels. Same way, EIH is the one which is relatively underperformed. But what is interesting for the stock is the stock used to be 220 in 2018 and used to be 240 back in 2007. Now the stock has come back to 240 after almost 15 years roughly. Out here, it is very similarly placed to what Indian Hotels was placed at 160, 180 when it made that high about 2007. So one by one, we've seen a lot of hotel names do well, even the small cap names. So we are into the next leg of the move. In the short term, there could be another, say, 15-20% move over the next few months, and then maybe a pause. So positive on the whole sector, buy on dips continues.
You know, Chakri, wanted to get your senses as well. I mean, food aggregator, food, you had Jubilant as well, which perked up very smartly yesterday, and the hotel names. It's clearly the urban consumption which is in the limelight once again. What within the hotel pack do you like?
You know, all the hotel pack, the entire hotel pack is looking good, you know, whether it's Chalet Hotels, Indian Hotels, EIH, Lemon Tree, you know, all these companies are seeing a business revival, corporate customers coming back, domestic, private functions coming back, F&B business increasing, and having a pricing power, which this industry did not have pre-pandemic. A combination of all these things, and they did not add capacity because of, thanks to pandemic, they did not add any capacity in the last 3 years. So everything is flowing to the bottom line. The operating margins will increase in this for the next year and the following year. And therefore, you know, I think Indian hotels did nothing. It has a huge amount of debt that has come down. Similarly, you know, Chalet Hotels in a better space. So therefore, I think the space will continue to do well.
We're going to move from hotels and go back to the month of August. Banks and IT, or IT and banks. Well, banks are down, IT must be up. Will this trend continue in the month of September? And that is what I think is important here. That's yesterday's data. Now, month of August. Banks yesterday were down. In fact, HDFC Bank yesterday led the decline. But if one really looks at how the month of August has moved for the Bank Nifty and for the IT index, you would actually see a bit of a divergence there. And the divergence, I think, is very, very prominent in the way how things are stacked up. Banks are down 3%, IT is up 3%. So, Naresh, will this convergence between bank and IT, will it meet at some point in time, which is banks will start catching up and IT will start underperforming, or will this convergence or will this divergence only exemplify or amplify? So, will there be divergence or will there be convergence?
So my view is banks could do better from here on. As an index, it could be difficult to say because HDFC Bank and Kotak Bank have not gone anywhere. But if you look at an ICICI Bank, Axis Bank, a lot of other banks look very promising, and IndusInd Bank. So the view is it could get selective. The top two, say the top heavyweight, may not do anything like HDFC Bank, but rest of the banks are in a strong trend, and they should actually take a much bigger move going forward. So you have ICICI Bank at 960 levels, which is where the previous high was. Axis Bank closer to 1000 is the previous high where it was. Then you have IndusInd Bank, previous high at 1430. The stock is at 1390. So clearly, these are 3-4 names in the banking space which are waiting for a breakout move, which is possible. So from current levels, they could do well. At the same time, IT is in a sideways consolidation move, the large cap names. So the only interesting name in IT is NCLT Tech, which is making structurally strong patterns. So overall, the views banks could do well from here, specifically ICICI, Axis, and IndusInd Bank.
Kunal, again, I go back to that same point again, which is that at the upper end of the range, Kunal, we are getting into resistance. At lower end of the range, we are getting into support. But if I look at yesterday's price action in isolation, just Kalka market, only yesterday's market, intraday graph, please. We reversed 100 points from the day's high. We did not latch on to global cues. And today we are about to open flat. What are the chances that after a flat start, we may just fall more?
I don't see that as a major chance and a major probability. So, you know, Nikunj, the indices, they tend to mirror what happens to stocks, or they tend to replicate what happens to stocks internally. What's actually happened is that in every phase of a market trend, when there is a sideways range, when there is a breakout, uptrend or a downtrend, there are sectors which change their patterns as such. So for example, in this month so far, you've seen the Nifty Pharma Index actually underperforming, the Nifty Realty Index actually being on the negative side of 2.5 to 3% approximately. Banking stocks are down some 2.5 to 3% approximately, but the IT index has managed to make a comeback. So it's a classical example of a churn which has happened. In a bear market or in a very sharp correction, you would probably have most of the sectors or large part of the sectors underperforming in the benchmark index as well as giving negative returns. But when you have sector churns where there are few sectors which tend to offset the market gains, we call that as a corrective phase. Then we go back towards the traditional phase, that which are the strong support points that every time the indices tend to take or a retest at a certain level, you see a bounce back on the index. That happens to be closer to 90,300 mark, say plus or minus 50-100 points or on an index on the spot level basis. And the best part about the market so far is that the rollovers for the next month is still at 110, 120 points premium for the index. That would not have been the case had it been an extremely bearish or a negative view for the indices. These are a few of the reasons why I would not be extremely bearish on the indices. Yes, we might go through a corrective phase. There may be another 100-point odd correction which could probably be in the offing somewhere down the line. But then, whether this could have a major impact on the negative side, I have my reservations there.
Chakri, what's your view on the Zee saga that's playing out? Yes, the SAT is saying that the Sony merger with them is a public interest issue. Today, then as well, the spotlight is going to be on the NCLT hearing out IDBI's plea for insolvency proceedings. What's your take?
You said it all in terms of, there's so many moving parts in the case of Zee, and that, kind of detracts from its underlying fundamentals. Underlying fundamentals actually are very strong. If you look at the current price, it does not give any valuation to Zee's OTT business. And you put whatever kind of multiple that you want on its existing business, it's still an undervalued stock. But I think that will get ignored because of the current NCLT promoter issues and all the other factors that impact it. So until we see greater visibility, I think it's best to stay away from Zee.
Stay away from Zee, that's the advice coming in. Naresh, just wanted to get in your take on the charts on Zee Entertainment.
So Zee should now continue to stay in this band of 290 to 250 going forward, unless there is a new trigger. 290 is the price point where it has seen a previous gap up back in March of 2022. Then a recovery in October of 22 also. We saw the stock peaking out at 290. Even in the current news, we saw a spike and it peaked out around 290 levels. So 290, 300, 290 crossing would be the next indication, but that would require some bout of news. So technically, yes, the stock has bottomed out. It has made that 180 to 200 was a strong base, and now 290, 300 is a resistance. If that crosses, then maybe we can go towards 380. The only reason it starts looking interesting is the fact that the whole media space has started doing well. So Sun TV has also broken out on multi-year charts. We are seeing the smaller names also do well. So out here, would wait for a move about 290, but at current levels, the better choice would be Sun TV because there is no news around it.
Meantime, I just wanted to get in a take as well on some of the other stocks that will be in the spotlight today. For instance, you've got a Titan. They're talking about how now they're looking at a wider play. Premium watches is something that they're clearly going to focus on. Venky's as well in their annual report indicating that the growth in the poultry sector is going to continue to be fairly strong. So those are some of the other stocks that will be in the spotlight. Along with that, and SJVN, they're seeing that they see an annual revenue of about 10,000 crores from operational power stations over the next 3 fiscals. So these two are going to be some of the newsmakers. And Chakri, one sort of resounding theme that we have been seeing across the board seems to be premiumization, be it autos, the consumption space, or sectors really across the board. How are you looking at this theme really playing out from a stock-specific standpoint?
You're seeing it in the hotels where there is a greater amount of dining out. For instance, if you look at consumer good companies, companies like Dixon have actually benefited because they are the ODM for many manufacturers. They have the ability to sell various brands, and the customer doesn't know which brand the underlying company is manufacturing, but Dixon benefits. So I think it manifests in several ways. Now, if you have the new EMS companies. Now with the EMS companies with the electronics manufacturing, which is under the PLI, will also benefit because of a customer premiumization. And so the range of the sectors that will benefit is actually quite widened now.